It's time now for your call sheet, where we look at the topics driving the trading day ahead. The crew members today are Dan Ives of Wedbush, back with us from the A block of our show. Let's bring in Ryan Dietrich of the Carson Group and Stephanie Link of Hightower. They're both CNBC contributors. Now, let's start with our first topic, market. New month, new record highs for the markets overall. Ryan, I'm going to start with you on this one here. You've been bullish for a while, and to be fair, you have been correct about it. But at some point, these markets come to an end. Will it be anytime soon?
Well, good morning, Dom. Thanks for having me back. We don't think it's anytime soon. There's a few ways to put this. June's got something for everybody. June in a midterm year is the worst month on average, but 9 of the last 10 years it's been higher. So we know we've had a lot of momentum in this market. Are we stretched? Of course we're stretched. Up 9 weeks in a row. I've been up 10 in a row since 1985. But one thing I think it's really fascinating, listeners need to know. This bull market last week just topped the previous bull market, or the longest bull market since 1962-64. All right, so now it's the 8th longest bull market ever. And you look at those other 7 bull markets, Dom, that made it this far. The average length was 7 years. I'm not saying this is going to go 7 years, but we are saying when bull markets get this old, like this one continues to do, they usually don't end anytime soon.
All right, from Stephanie, from a portfolio manager standpoint, this is one where there have been massive gains in certain key parts of the market, which has led Victoria Green early in our show to say that it's time to rebalance, take some of the profits there, reallocate them elsewhere. From your perspective, has the catalyst at new market highs led you to rethink allocations, take profits some places and deploy them to others, or are you riding with what has worked over the course of the past, say, couple of years?
I'm kind of riding with what has worked over the last couple of years, but I am kind of broadening out into other sectors as well. So I don't want to give up on technology, Dom, because we really are seeing a phenomenal situation with this whole AI food chain boom. But I think you can play the AI food chain via the industrials, via the power companies, the energy companies, the commodity companies. Fairly new position for me has been Alcoa. They're going to benefit just like copper is benefiting from this whole electrification. So I think you can still own tech. I definitely want to be there, but I do think that there are other places as well to play that tech theme.
All right, Dan, we're talking record high levels in the Kospi in South Korea, record high levels in the Nikkei 225 in Japan, record high levels here, all driven by that tech momentum. This is your bailiwick. This is your wheelhouse. You cover many of these tech companies. This tech momentum, there have to be standouts there that continue and others that may peel off. What exactly are the ones that you think are the most positioned, and what parts of that thematic trade are going to have the most legs going forward?
Look, the chip super cycle is going to continue. And look, and I've seen it firsthand in Asia. I mean, demand and supply is 12-to-1 for NVIDIA chips. And what that means, bullish for AMD, bullish for obviously all the memory players and everything that we're seeing play out. But I continue to think if you look what's happening on the hyperscalers, that's where I think you want to continue to be focused. Amazon, Google in particular, as well as Microsoft. And look, the SaaS apocalypse, as we've talked about many times, it was a ghost trade that was way overdone. You can't paint them all with the same brush. Stephanie and Ryan talk about it all the time. And I think now you're starting to see second, third, fourth derivatives, what Stephanie talked about. It's going to happen across the board. Infrastructure, energy, chips, software. Look, we're talking about $4 trillion that's going to be spent in this AI revolution.
Steph, you mentioned the derivative trades, right? You mentioned Alcoa as one of those. You also mentioned you're not giving up on tech. Mm-hmm. So let's talk about the primary first order in that technology trade. Dan laid out a few of it on the shopping list. What exactly stands out to you on that tech-specific trade?
So on a pullback, Dom, because some of these stocks are up a lot, but I have a lot of conviction in Marvell. Their optical business is growing north of 50%. Their custom ASICs, they and Broadcom have an 80% market share. That's growing 20%. That's going to get to 100% growth by 2029. I think there's $10 of earnings power in Marvell. Snowflake blew it away, and they're clearly a winner, and that stock really has lagged up until last week. IBM is a winner, and we haven't even talked about quantum computing yet. That's going to be a bonanza for them, and I like Dell. It's had a nice run, but I think there's much more to go. I mean, the numbers and the revisions, Dom, that we're seeing are just staggering.
All right, Ryan, one of the big trades over the course of the past year plus at this point has been to sell/short software companies and buy those chip stocks. It's been a massive pairs trade on hedge funds and everything else going forward. Does it still have legs, or are we going to see this mean reversion where people say, hey, maybe the SaaS apocalypse is overdone? We're seeing a bid to all those names this morning, and that semiconductor trade does cool off a bit.
I think it's possible. I mean, just last month, software had one of its greatest months ever. I think just the theme that we've had is just technology in general. That baton does get passed around. So, have maybe a little bit of both. One thing we've done, Carson Group, right? We manage a lot of money. We have some low vol over here and some high momentum over here. We kind of call it like a pair trade. Now, we did trim some momentum recently a little bit, just kind of went into some S&P 500 ETFs. Again, ring the cash register a little bit there. But one more I think the listeners might like here. June is the only month in the history of the stock market, out of all 12, that the S&P 500 has never peaked. So maybe we have a little bit of a peak after a 9-week rally and we pull back, say, 5 to 8%. But never have we had the ultimate peak, Dom, in June. And we don't think this year is going to be the first one. All
right, now let's go to our last topic. We got a lot of eco data coming up, and specifically the granddaddy of them all, the jobs report coming out right on Friday. Dan, how much do we need lower rates for this tech momentum to continue?
Look, obviously you need it over the long term, but right now I think the market's able to kind of see through what we're seeing in terms of inflation, oil obviously spiking. But over the long term, you're going to need to see Warsh ultimately at one point cut rates. But right now, it's resilient because investors are able to see through. You want to own the tech trade. You can't get caught up in some of the macro and the geopolitical. That's how so many of the bears have missed, these transformational tech moves.
And Stephanie, your perspective, what's the most important thing you're watching on the eco calendar this week?
Well, the economy is running hot right now, Dom, so I just want to continue to see the momentum. I think we get the unit labor cost numbers. That's going to be important. But we're at 3.8% Atlanta Fed tracker. And last week, the most important number was the Chicago PMI, the best in 4 years. And that speaks right to onshoring and AI boom.